Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, November the 17th. I'm Eric Wilkinson, and you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, how that comes in to impact the markets with some of my market analysis. I do the same thing for you folks out there in these daily market commentaries, but I'm going to go a little bit further and talk about my option strategies I'm implementing into my portfolio based on the assumptions I come up with on my market analysis. So you guys can follow along with that. Also, what we do here is when you come up with an assumption on any given underlying, whether you've heard it on the news, you've got an indicator or any of those things, what I've done is when you have an assumption, we have a guideline set out for you guys to follow along in order to find the right strategy for that assumption. And it's not just picking an option strategy out of the hat. We don't walk into any given day and say, hey, I need to put on some long calls. No, what we do is we say, hey, I am bullish this underlying. I'm bearish this underlying. How do I take advantage of that situation with the highest probability of success? That's what I'm doing for you guys with these option strategies, is setting it up so that you guys have the highest probability of success when trading options around your assumption. All right, so without that further ado, let's get on with the economic data. As we talked about it, this week is pretty robust in the form of receiving economic data. Whether or not it's going to be good or bad is what we are looking for. So across the pond, not really a whole lot to see there, but let's get back here to the United States because we got a lot of stuff going on here. Core retail sales coming in at 0.2%. Now remember, that's going to strip out automobiles, transportation, because those are a little bit more volatile. People don't usually go out and buy cars in the winter and stuff like that. So we're seeing that number come off. Came in at 0.2%, expected to be 0.6%. And they revised last month's number down from 1.5% down to 1.2%. So bad revision there. Now you add back in automobiles. Well, it came in worse than expected too, so nobody's buying cars either. So it came in at 0.3%, expected to be 0.5%, and yes, they revised last month's number down as well. Importer prices coming off a little bit came off by 0.1%, expected to be a positive 0.2%. Now, I'm not hating on importer prices going down though. But that generally is expected to be lack of demand, price elasticity, and those things. That's why they're looking at that as being lower is bad. But right now we need lower prices on everything. All right, capacity utilization came in higher than expected at 72.8, expected to be 72.3, and a revision of last month's number up by a 0.5 percentage point as well. So that number looks pretty good. Industrial production in line with expectations at 1.1%, and a slight revision to last month's number higher, which is a good thing. So, we're starting to build up on manufacturing and ahead of the holiday season. One thing that's really waning on the market is that core retail sales. That's really what was pushing the market to the negative this morning, is when that came out. But then we got we got business inventories that came in higher than expected at 0.7%, which isn't a real surprise when we're seeing core retail sales and retail sales come off. That means that people are moving inventory, so we're seeing that build a little bit. And they're probably ramping up production heading into the holiday season as well. Now, the NAHB, which is the National Association of Homebuilders Index, came in at 90, expected to be 85. It came in 90. That is another just record breaker there. I mean, I went back in time and looked back, and since 2003, I think that's the highest reading we've seen. It's dwarfing everything else. So the housing market is going through the roof. If you guys are trading metals, copper prices are through the roof. Lumber prices are through the roof. So all of that is because of this housing demand happening, or the housing market's going crazy right now. So a lot of prices of the products that go into building a house are also doing very well. Now, we also have a plethora of Fed governors or monetary policy people speaking today. We had Lagarde speaking earlier today. He is for the ECB. And then for the Great Britain, we had Ramsden, I think, was one of them. And then later on today, we have Powell and Bernard speaking on probably interest rates and the economy and how that's doing. Now, something to talk about with this economic data, we're seeing retail sales and core retail sales come off a little bit more than expected. And this is a time of season where people are doing Black Friday sales a little bit earlier this year. Usually Black Friday sales come in after Thanksgiving, but we're starting to see some of those offers come out a little bit earlier, probably because even the retailers are seeing, the retail sector are seeing the people are waning on their purchases, where we were seeing some spikes with the last stimulus check. Now, something I'm really worried about and starting to get me a little bit more bearish across the board with most of the markets here is the fact that we didn't get a stimulus package. They were expecting a stimulus package in August. That didn't happen. August, September, October, and here we are in November, and it's not going to come out until at least next year at this point, if we're going to get one. And so what does that mean? Well, there's all kinds of people unemployed. The economy is not doing very well. That tells me that the holiday season is going to be a bit of a wet blanket or a bust. So that, to me, is saying, hey, heading into this holiday season, we're starting to see more and more stringent lockdowns. Some places are having more stringent lockdowns than at the beginning of the pandemic. So that means people aren't going to be spending. That means people aren't getting out there. That means the economy is going to suffer. And, you know, with the holiday season, those are things people are buying that they normally wouldn't buy for a holiday season, right? You know, you got gag gifts and buying things for your kids, right? Well, that doesn't happen all year around. And if people are unemployed and aren't making money, then they aren't able to spend anything. So there's a couple of things there. And if they're throwing it on credit cards, then that, you know, is going to cause all kinds of debt issues with the consumer going forward. So I'm a little bit more bearish. And as the days go on, I'm getting a little bit more and more bearish here, the more I talk myself into it. But at the end of the day, I'm going to keep myself mechanical, looking for new opportunities. We can see here crude oil futures are coming off a little bit, but it's right there at the point of control. We've talked about this $40 a barrel. If it's that 40 handle, it's probably, 40 handle. It's probably right around where it should be, because that's where the point of control is. And until we see manufacturing start to ramp up, or coming out of this pandemic where people will start to drive more, travel, get on airplanes, crude oil is going to struggle to move, especially on the manufacturing aspect, the demand. We did see, though, that it's going to try and hold up a little bit. OPEC is talking about extending some of the production cuts because of the glut of oil out there right now. So that's probably what's holding crude oil up a little bit, is the thought that they're going to start limiting some of the supply. All right. Bonds are moving higher. This is actually causing, they're almost higher by a point at this earlier today. They're much closer, obviously. But bonds are starting to make a bit of a move higher. I've been talking about this for several weeks, and this whole slide is that the price or the interest rates aren't going to go higher. Fed isn't going to increase interest rates anytime soon, maybe not even for 2021. So how are the bonds starting to price this in well ahead of that? I think that they've gotten a little ahead of themselves, gotten interest rates way too high. Think it's going to start moving back towards the mid 170 handle. Now that we've gotten above this 50 Fibonacci, I've been talking so much about the 172 handle, we're back into that. So I think that the market is going to start migrating a little bit higher here, despite the fact that we have this 50-day. A lot of people say, hey, the 50-day crossed over the 200-day. That is long-term bearishness. It's like, I know on the bullish side, when that happens to the upside, that's called the golden cross. I don't know if it's called the golden cross on the way down. May very well be. Who knows? It's probably a tarnished cross or something like that. But anyway, we've started to make that move. I think bonds are going to start moving higher. Interest rates starting to go lower. That's causing the bank sector to really start to see some weakness there. We've got some chart patterns in American Express and a couple of these other credit card companies. I think that they're seeing interest rates start to go down as the bonds start to go up. They're also seeing more and more people using credit cards because, you know, they're not making money. They're heading into the holiday season, all those reasons we just talked about. So those companies are starting to show a little bit of a kink in the armor. I'm not saying that they're full blown coming off, but we're seeing some chart patterns where it looks like a toppy type of pattern is being confirmed today. We've got NASDAQ off on the day. That rally, we were trying to come back on some of the NAHB, starting to weaken now throughout the day here, as you can see with the NASDAQ off by about 21 points. E-mini S&Ps holding up pretty decent. Why? Well, because Tesla all of a sudden is going to be coming into the S&P maybe. I don't know. Also, some of that tech is a little bit rich right now, and people probably looking to roll out of some of that tech that they've done so well with and look for opportunities elsewhere. All right, you can see overnight we got the economic data points on the retail sales. That's what really pushed us to the lows of the day. And then you can see right here, basically, this is where we got our NAHB at 8 o'clock my time. And the market has started to move to the upside now. Like I said, it's starting to look a little bit heavy at this point. Like some of that news is out the way and everybody's waiting for Powell to speak, and hopefully he says something positive for the markets. But at this point, it feels like a very wait and see kind of action day. So I'm sitting on my hands. I am keeping an eye on especially the banks, the credit card companies, where we're seeing some of those topping patterns. Let's just see if I can find one. Here's Tesla. Tesla's up over 10% earlier today, up over 50 points on just the news of going into the S&P. It's starting to wane a little bit at this point. Made Elon Musk the third richest man in the world at that point. Then we go over and look at, let's see, Axp American Express. This is the chart pattern I was looking at. You know, earlier today it was looking much more confirmed, but still, this is a pretty bearish setup here with these three candles, and this is looking to me like we are going to start rolling back over. I didn't remember seeing what Visa looked like, but you can see it's a similar pattern. MasterCard, we can look at it's pretty, it's moving towards the highs, but off the early morning, it was starting to look like we were getting a little bit toppy and wanting to roll over a little bit there. So keeping an eye on those things. Other than that, I'm pretty much sitting on my hands, keeping an eye on my IBM. We'll talk about IBM real quick because it's coming off today. And if you guys remember, I had some puts in there on the move higher. I covered those short puts. Now I have on the covered calls. Those are expiring pretty soon, so I'm going to be seeing some real massive theta decay start to come out of those. And I'm looking to cover those. You know, they've decreased by about 50% on the premiums. I collected $1 for those, the 120 calls in there. This move higher, they were trading a lot lower earlier today, but I only have 3 days to go, and I don't think that IBM is necessarily going to blast off through that 120 handle. If it does, fine. I'll be happy to get out of that trade. I've stayed mechanical with it, lowered my overall cost basis. We'll talk about how we traded that if that does happen, and or if I cover those short calls for nothing. But at this point in time, I'm ready to wash my hands of IBM at 120 if I get that opportunity. It would be a scratch on where I'm long the outright stock, so that would be a scratch. But because I've stayed mechanical over this entire course, it would course of time since I've had it, that would be a huge win there. All right, so that's all I've got for you guys today, other than we got to take a moment to go over our disclaimer. Please take a moment, because it is there is risk involved in trading. All right, so make sure you know your risks, make sure you know how to take your reward, stay mechanical, and read over this disclaimer. So if you can't take that, take it easy.